Hello, I'd like to talk to you today about an interesting, very recent case involving stamp duty land tax. This is a case that was heard earlier on this year. The case name, it's a first-tier tribunal decision, and the case name is PN Bewley Ltd and HMRC. And what it involved was an appeal against an amendment that was made to a stamp duty land tax return, which resulted in the original stamp duty land tax being increased fivefold, which the taxpayers didn't appreciate. The story goes that the company involved, in this case PN Bewley Ltd, bought what by all accounts was a pretty run-down and dilapidated residential property in Weston-super-Mare down in Somerset. One assumes that it was bought for development purposes, but that's irrelevant for this purpose. The company paid for this residential property £200,000. And the stamp duty land tax return that was filed at the time of the purchase showed SDLT, first £125,000 in accordance with the normal residential rules at 0%, last £75,000 at 2%, £1,500. So, doesn't seem too bad. There was, however, subsequently an inquiry into that tax liability, and towards the end of 2017, the residential property had been bought by the company in early 2017, so towards the end of that same calendar year. As a result of that inquiry, the SDLT boys said, sorry, that original stamp duty land tax return isn't quite right. Because, as you will recall, one of the things that had been included in the previous year's Finance Act, the Finance Act 2016, was the introduction of what nowadays we tend to call the 3% stamp duty land tax surcharge. You may recall that was initially aimed at our better off clients acquiring second properties, but it also applies where the acquirer, the buyer of the residential property, was anyone other than an individual. And that, of course, would include people such as companies and discretionary trusts. And one suspects that what had happened is that the company's solicitor, when the original stamp duty land tax return was filed, not being familiar with what at the time was really pretty new legislation, had overlooked the requirement that you had to have a higher charge because it was a company that was buying this property, and therefore filed the original stamp duty land tax return as though that residential property had been bought by an individual. But as I say, if a residential property nowadays is bought by any non-individual, such as a company, the 3% surcharge applies across the board to every rate. So what the stamp duty guys said is that actually the stamp duty land tax charge should have been the first $125,000 not at 0% but at 3%, which is $3,750, and the next $75,000 not at 2% but at 5%, another £3,750. Total stamp duty land tax $7,500, 5 times as much as was originally paid. And HMRC's argument was that, of course, all the conditions were satisfied in order for the 3% surcharge, which had come in the previous year, to be applied. Now, in the notes which go along with this talk, I have just briefly reminded you of what the key requirements in order for the 3% surcharge to bite where we had a non-individual client, like a company or a discretionary trust, who was buying the residential property. Condition 1, the purchaser was not an individual. clearly that was satisfied here. Purchaser here, remember, was this company, PN Bewley Ltd. Secondly, the transaction had to constitute a major interest in a dwelling. We'll talk about that in a little bit more detail, the word I gave emphasis to, dwelling, but clearly purchasing a freehold property constitutes a major interest, so that condition was satisfied. Thirdly, it is a rule that in order for the 3% surcharge to bite, the property has to cost £40,000 or more. In this case, it cost £200,000. So that condition was satisfied. And fourthly, the property was not subject to a lease. It wasn't. It was a freehold purchase by the company in those circumstances. So basically, the stamp duty people were saying, we think that all four of those conditions has been satisfied, and therefore, actually, the original stamp duty land tax submitted was incorrect. You now owe us another £6,000, and no doubt a bit of penalty and obviously some interest. When it was looked into, the argument that the taxpayer company maintained was that, yes, indeed, 3 of those 4 conditions are indeed satisfied, but we dispute whether what we actually had was a major interest in a dwelling. And we don't think that what has been bought is a dwelling. Now, I have drawn your attention to the relevant legislation in the Stamp Duty Land Tax Code. This is set out in Schedule 4ZA, believe it or not, Finance Act 2003. Remember, Finance Act 2003 is where normally you will turn to find anything you need to know about stamp duty land tax. And in paragraph 18 of that schedule, it says that when we look at what we mean by the word dwelling, a building is considered to be a dwelling if it is used or suitable for use as a single dwelling, or is in the process of being constructed or adapted for such use. So even if it's being built or converted, but isn't yet ready, can you see, that would still count as a dwelling. So I think here what they were really looking at is the first bit of that definition. Was it used or suitable for use as a dwelling? And this essentially was what we were looking at. I should incidentally just point out that although those words occur in the stamp duty land tax legislation, there are very similar references to dwellings in other parts of our tax code. For example, as I'm sure you're aware, the Finance Act 2019 recently extended the capital gains tax rules for non-residents to cover a UK capital gains tax charge on the disposal of any residential or commercial property, even for non-residents. Previously to the Finance Act 2019, non-residents, remember, were only caught if they disposed of at a profit UK-situated residential properties. Now it is UK-situated properties of any description, residential, commercial or industrial, in those circumstances. And as I say, in that legislation, the word dwelling crops up, and therefore the impact of this case that we'll see in a minute could equally have a knock-on effect in the capital gains tax code as well. There is also in inheritance tax, as I hope many of you will remember, some rather nasty new rules that came in the Finance No. 2 Act of 2017 in relation to inheritance tax charges on what are usually referred to as enveloped UK residential properties, basically designed to counter the practice of wealthy foreigners who are not domiciled here in the UK, buying property, let's say in London, and instead of buying the property directly, buying it via typically an offshore company, which then held the London property. And of course, as a non-domiciliary, you owned foreign property, the foreign company shares, and therefore, of course, it counted as excluded property. And what the Finance No. 2 Act of 2017 says is that no, from now onwards we're going to look through that. So it is no longer excluded property. And in that legislation too, a very similar definition of dwelling is to be found. So actually, this case could have quite a widespread implication way beyond the confines just of SDLT. Now, as I said, the key issue was whether the property in Weston-super-Mare in Somerset was suitable for use as a dwelling. The first HMRC, I should perhaps say, HMRC took the position that they said, yeah, it is. It's a house, it's got a roof, etc., etc. It is, of course, and obviously has been lived in as a residential property in the past. It therefore meets the criterion. But the taxpayer company, and indeed, you'll be pleased to hear, the first-tier tribunal judges took a slightly different view, because it was undoubtedly, as you probably might determine from the fairly modest price paid for the property not so long ago, the property was in extremely poor state of repair. All the radiators and pipe work had been removed from the property, because presumably they were old-fashioned or rusted or beyond restoration. And also, in the property, there was presence of significant amounts of asbestos, which would obviously require specialist removal. So in other words, when the company bought the property, could you or I have moved in and lived in that property reasonably comfortably? And I think most of us would agree that the first-tier tribunal judge's conclusions was that the property as it currently stood was not in a fit condition to be lived in. Therefore, they decided that the property was not suitable for use as a dwelling, and that had actually an interesting repercussion, because they then treated the property as non-residential, like commercial property. And as you will recall, the rates of SDLT these days applied to non-residential property are much more modest than to residential property, and of course there isn't the possibility of a 3% anyway. With non-residential property, you have a larger initial slice that is zero rated. It's the first 150,000. You then kick in for the next slice of 2%. So in this case, that would be 2% from 150 up to 200,000, which, remember, is what the company paid for the property. That means that actually the correct SDLT was £1,000. So actually, far from having your original stamp duty land tax bill quintupled, you got a repayment of £500 compared with the £1,500 that the company had originally paid when it had completed the transaction back in early 2017. So, yeah, that was a good outcome as far as the company was concerned. And as I say, the discussion in this judgment takes into account the various factors that have to be considered when determining whether or not a property is a residential property. And as I said, I think this judgment may, albeit a first-tier tribunal decision, may have some interesting implications, not just for stamp duty land tax, but for other taxes like capital gains tax and inheritance tax as well. Thank you for listening to this talk. My name is Robert Jamieson.